current portfolio manager at CIBC Wood Gundy. Andrew, great to see you. I know, any one moment it's impossible to predict really how the stock market's going to move, but it has looked like a turning point, hasn't it, with the drop in these big tech stocks, especially in the US.
Well, Andy, great to be on this morning. We're seeing a little bit of a relief, stability entering the market today. I don't think anyone has any conviction right now, Andy. To your point, we have no clue what the policy framework looks like hour to hour, let alone day to day or week to week. So I think what we're seeing this morning, a little bit of a relief bounce. We'll see how long it sticks. This is early in the morning, obviously. We'll have to wait till this afternoon. But, this trend away from the States, I think, has just been profound. And I think 2 months ago, Andy, you and I would be talking about Europe's economy underperforming, the market really not looking that attractive, pro-growth policies in the U.S. looking fantastic. And what do we have right now? We've got a performance gap between the Euro Stoxx 50 and the S&P 500 that yesterday was approaching 15%, which is absolutely incredible. And I don't think it necessarily ends today with the bounce that we're seeing.
So Trump and his Commerce Secretary, Howard Lutnick, do you think they're in danger of having overplayed their hand? In other words, they may have underestimated how this would worry investors, their aggressive trade policy?
Well, I think they've definitely underestimated the market reaction to the tariffs that have been put in place and the threats down the road, Andy. I think that was a complete misread by the administration. I think the other misread is just the fact that, whether we're talking about Europe or we're talking about Canada, the level of conviction to, retaliate, but not only just to retaliate, to basically make use of a fiscal position, relatively speaking, Andy, that is better than what the States has called. We're talking this morning about the fact that, how on earth is Congress going to get tax cuts passed when they've got a deficit that's already widening, and you're going to have a pouring out of requests for support from the federal government for companies, for people that are affected by tariffs. Take a look at Europe this morning. We saw Germany pass you reach an agreement with the Greens on a new debt deal. It's a different framework, and I think a framework that they weren't anticipating.
I think it was this morning I saw Trump's tariffs called a sales tax. I can't remember who the commentator was. I mean, there will be a tax grab from these things. They will, in theory, help pay for prolonging his previous tax reductions.
Well, I mean, it's a great assumption, Andy. I would love to assume that the tariffs are going to rake in $1 trillion for the U.S., but that's clearly not the case. Right now, I think we're looking at about $65 billion is the latest estimate from the CBO. Of course, we're in fluid environment right now where things are changing. But I don't think we're going to come close to what they're going to require to not only pay for the tax cuts that were originally planned coming into this year, but now, again, there's going to be a requirement for support, sometimes the support, by Republican governors that are now looking at populations that are going to be under duress, paying more for products, displaced perhaps in terms of employment. And you're going to need so much more, Andy, in terms of revenue from these tariffs. And of course, if you have a weaker economy because of the tariffs, your government revenues tend to go down anyways, or your consumer tax revenues go down.
We're still early in 2025. You reckon it is good? Well, it's always good, but it's an opportune time to watch your equity fixed income balance?
Yeah, I would. And I think, the one positive thing I'll say, Andy, this year is that, that dynamic between equities and bonds, that machine has worked, right? So if you take a look at the bond market in the last few weeks, excluding Europe, because we're dealing with a different situation, but just here in North America, the bond market has reacted positively to anticipation of a weaker economic environment because of the tariff policies that are being put in place. So for balanced portfolios, the sting of the equity market in the last couple of weeks has been subdued. I would still say, though, that there's opportunities here. When you get these pullbacks, if we can get a little bit of stability, you're now seeing a lot of those large tech names, Andy, offering better valuations and better entry points. So this might be an opportunity to, if you're sitting on cash, put some cash to work, again, very reasonably. I wouldn't be betting the farm that we're going to have stability over the next few weeks. But there are opportunities out there. You just have to see them and basically put cash to work right now. Just
looking at one stock, Rheinmetall in Germany. People who spend too much time reading about the Second World War will know that they used to make cannons to help shoot down Allied bombers. Of course, they used slave labor or forced labor. But that stock, a defense name, among other things, has gone up 123% this year.
It's incredible, Andy. I mean, when we sit here at home and we think about defense spending, if we're entering a period of instability and we say, we should be putting money to work in defense companies, we think of companies like Raytheon, and Raytheon hasn't done bad. But to your point, Andy, if you look at some of the European weapons makers right now, especially in Italy, where we've seen a lot of the arms companies in Italy really just do a moonshot. Again, 2 months ago, we were not talking about this. We weren't anticipating it. But I think this is a reflection of what Europe is intending to do going forward. Talk of getting to at least 3% of GDP on military spending, potentially up to 5%. This may be what the Trump administration wants, but it's actually benefiting European equity markets right now much more than it's benefiting U.S. equity markets. And again, I don't think that trend necessarily shifts anytime soon.
Andrew, it's always great to talk to you. Thank you very much indeed.
Thank you, Andy. Have a great day.
Andrew.